the bond market has behaved in the way that I was anticipating that it would behave. I think I and I know you would be very skeptical, and I would understand your skepticism, and but I think if we were to take positions in the market, given the deceleration in the economy, it's not going to happen in the second quarter, but after second quarter is always the best quarter. So growth should actually recover. Technically, hypothetically speaking, we should go back to between 2.5 to 2.8% for the second quarter. 1% between 1% and 1.5% looks like what the first quarter numbers are going to be in terms of GDP. But after the second quarter, the third quarter, which is typically the second best quarter statistically and historically, is going to be significantly below that, and it's going to be probably much closer to trend, which is about 1.7 to 2%. And then the fourth quarter is probably going to be significantly slower and into trend. And then if we're going to get a couple negative quarters, if the I guess the issue right now is that the Trump administration is putting a lot of pressure on the Federal Open Market Committee and directly on the chairman. And I don't see any way out in terms of them maintaining their no rate hikes for 2019. I think that they're more likely going to either cut in as early as June or July. But it seems like if there's more likely going to be a rate move lower, and I would say it could happen as early as June or July, but it's most likely going to happen in September when they stop reducing the runoff of the Federal Reserve balance sheet. So in combination with stopping the runoff, they may actually start to reinvest principal payments again. So they'll start a small amount of large-scale asset purchases, not in the same range that they did when Bernanke initially started it, but they'll start to reinvest the coupon income that they receive on the mortgage-backed securities and the treasuries back into treasuries and mortgage-backed securities, or they may just focus on the treasury market. And I think that that's more likely going to happen in September because that seems that they can kill two birds with one stone. They can cut rates 25 basis points. It is possible too. I wouldn't rule it out, given that the economy is definitely going to decelerate in the second half of the year, and the third and fourth quarter are going to be probably substantially closer to trend growth. And if the world economy continues to slow down, which it looks very likely, given the pace of growth in Europe and also the potential pace of growth in Japan, as well as China's rebalancing, and their GDP is definitely going back toward where they were initially anticipating, which is about 6%. So it could drop down to 5.5% or stay at 6%. But either way, that's going to be a substantial lag on the global economy, which means that the Federal Reserve is going to have to cut rates, even if or they're going to be more likely to cut rates. If they cut rates, it's not going to change. It changes the discounting in the equity market. So if you have the U.S. consumer still in the position that the U.S. economy is in, which is the strongest of the advanced economies, which means that the trade deficit's going to widen. The current account deficit's also going to widen in tandem with the trade deficit, and also the government budget expansion is going to widen the fiscal deficit, which means all those things have to get financed each month. And the larger the financing each month, the more foreign capital has to flow into the U.S. economy. And typically what happens at the very end of a late-stage cycle is that foreign capital goes into very short-term investments, meaning that it goes into the portfolio channel, which typically has a positive effect on prices of bonds, and also has a positive effect on equities up to a certain point in time. And then eventually that money dashes out of there once the U.S. is actually solidly in a recession, and then sort of the dollar depreciates. You get the domestic rebalancing that I talked about last year, kind of early to the party. So if the Fed were to cut rates, and depending on how much they were to cut, so if they cut 25 basis points, you're still going to get the recession, but they could push it out a little bit further. They may be able to push it out all the way to the second half of 2020. So I was anticipating that it would happen in the first and second quarter of 2020, but it may not actually happen until the third or fourth quarter. And if they were to cut by 50 basis points before the year end, or if they were to do a 75 basis point cut before the end of 2019, which means that they would cut much more aggressively in June, and maybe in July, then again in September, and then again in December, which would be 75 basis points. That could probably extend the cycle a little bit longer, maybe out to the first quarter of 2021. It's very possible that trend growth could decelerate to trend and still remain slightly above of a recession for maybe a couple more quarters because they can lengthen it out. It's still a recession and a global rebalancing by the U.S. being the deficit country has to happen at some point anyway. It's not a matter of if, it's more just a matter of when.